If you have money sitting in a savings account right now, there's a very good chance your bank is making 10 to 30 times more on it than you are. Not investing it, not risking it, not working harder than you, just using it. And the wild part is, they're doing it with your permission. Let me show you what I mean. Imagine someone named Alex. Alex has $25,000 sitting in a savings account at a large national bank. It's his emergency fund. 6 months of expenses. He did exactly what financial experts recommend. His bank pays him 0.4% APY. That's about $100 a year, $100. Now here's what's actually happening. The moment Alex deposited that $25,000, the bank didn't lock it in a vault. It didn't just sit there waiting for him. It went straight to work. Not for Alex, for the bank. Banks operate on a simple model. They take deposits at low interest rates and lend that money out at much higher rates. The difference between what they pay you and what they earn is their profit spread. Right now, average credit card interest rates in the United States are over 20%. Auto loans are around 7 to 9%. Personal loans can be 10 to 15%. Mortgages are often 6 to 7%. Your deposit helps fund all of that. Even if the bank earns a conservative 5% using Alex's money, that's $1,250 a year generated from his $25,000. Alex gets $100. The bank potentially earns over $1,000. And that's before counting overdraft fees, ATM fees, debit card transaction fees, or the short-term investments they make with pool deposits. Your money is not resting. It's part of a system designed to maximize profit. Now maybe you're thinking, that's why I use a high-yield savings account. Good. That's smarter. Let's say someone named Sarah moves her $25,000 to an online bank paying 4.5%. Now she earns about $1,100 per year. That's a massive upgrade from $100. It feels like she beat the system. But look closer. First, that 4.5% is not permanent. Savings rates can change at any time. One shift in Federal Reserve policy and that rate drops next month. Second, taxes. Interest from savings accounts is taxed as ordinary income at both the federal and state level. If Sarah is in the 24% federal bracket and lives in a 5% state tax state, she loses nearly 30% of her interest to taxes. Her $1,100 becomes closer to $800 after tax. Still good, but not the full amount. And here's the bigger question. Where does that 4.5% come from? The bank is still lending, still investing in short-term government debt, still earning more than they pay her. They're just sharing a larger slice. So what happens if you remove the middleman? Right now, short-term US Treasury bills are yielding somewhere between 3.5% to 4%, depending on market conditions. Here's something important. Interest earned from US Treasuries is exempt from state and local income taxes. That matters if you live in places like California, New York, or New Jersey. So if you earn $900 from Treasury bills, you may only owe federal tax on it, not state tax. That narrows the gap between a high-yield savings account and direct Treasury investing. And unlike savings accounts, Treasury yields aren't promotional. They're determined by government auctions and market demand. There's no up-to rate. No surprise adjustment email. It's transparent. Let's compare 3 simple scenarios with the same $25,000 over 1 year. Scenario 1. Traditional savings account at 0.4%. You earn $100. After taxes, maybe $75. Scenario 2. High-yield savings account at 4.5%. You earn $1,100. After taxes, maybe $800. Scenario 3. Short-term Treasury investment yielding 3.9%. You earn around $975. After federal tax only, maybe around $740. And you avoid state taxes entirely, depending on where you live. That difference can shrink dramatically. In some high-tax states, Treasuries may even come out ahead after tax, and you've eliminated the retail bank from the process. Now let's address safety. Savings accounts are FDIC insured up to $250,000 per depositor per bank. That's real protection. But US Treasuries are backed by the federal government, the same entity that stands behind FDIC insurance. You're not stepping into something speculative. You're staying within highly secure assets. What about liquidity? High-yield savings accounts give immediate access. Treasury ETFs can be sold during market hours with settlement in about 1 to 2 business days. Direct Treasury bills require you to wait until maturity. unless sold through a brokerage. So the solution isn't extreme. Keep your checking account for daily expenses. Keep short-term flexibility where you need it. But for idle cash, emergency funds, down payment savings, money waiting to be invested, understand where it's sitting. This isn't about chasing an extra 0.5%. It's about understanding how money flows. Banks are businesses. They maximize spreads. When you leave money in a low-yield account, you're essentially renting it to the bank at a discount. Most people obsess over cutting small expenses. Very few optimize where their cash sits. Yet many households across the US, Canada, the UK, and Australia keep $10,000 to $50,000 in cash reserves. At a 3 to 4% difference, that can mean hundreds or even thousands of dollars per year. Over 10 or 20 years, that adds up. Alex thought 0.4% was normal. Sarah thought 4.5% was winning. Neither asked the final question. What is my bank doing with my money, and can I do it myself? In many cases, the answer is yes. Not perfectly, not identically, but closer than most people realize. Your money is always working. The only question is whether it's working mostly for you or mostly for your bank. And once you understand that difference, you'll never look at your savings account the same way again.